Okay. Good evening, everyone. Sorry for the delay in the presentation. There was some technical issue, and also we were waiting for a few more participants to join in. Thank you all for joining us for today's webinar. Today we have put up a small presentation on how to analyze stocks technically. Basically, it's for a novice investor. It'll be easy for them to understand technical charts, and by the end of this webinar, hopefully you'll be able to take some inputs on how to read charts and how to take positions from these. I request you all to please mute your stay muted while the presentation is running. In case you have any queries, please feel free to drop in your messages in the chat box. Okay, so today we are going to discuss about the importance of chart patterns and technical analysis while investing. So it is more or less about the Cancelim way of analyzing stocks technically. As fundamental analysis is really important, technical analysis is equally important. This as we further go into presentation, you'll get to know more about this. Before we start off, a quick introduction. I am Raghavendra, and with me is Georgie. We are from the MarketSmith India research team. So today, broadly, we're going to cover three topics here. So understand why chart patterns work. So whenever, whatever it may be, broader world as well. If you look at products, so any product, the price of a product moves in a particular pattern. So anything broadly you take, you see that there is some pattern movement, some catalyst that affects the stock movement. Similarly, it also happens in the stock markets as well. So we are going to elaborate a bit on how patterns are recognized and how important patterns are other than fundamentals as well. So the next aspect we would also cover is once we understand the fundamental strength of a stock, we need to know, is it the right time to enter the stock, or else is the stock technically a bit extended. So you'll get to know the importance of it as we further proceed into the presentation. So it is more to do about how the buyers and sellers in the market balance the price, and how the stock price is maintained as we go. As the stock trades on the exchanges. The third one, why is it important to incorporate technical analysis in your daily routine, that is investment routine? Technical analysis, I personally feel, is a really important aspect of stock analysis, because it will basically give us a proper discipline, and it is a bias-free method of investing in stocks. Sometimes what happens is you might not get the conviction of investing in a stock. However, the technical analysis to an extent might provide the plan for your future investments, and it will basically improve your conviction levels, and it will help you to analyze stocks entry and exit points. In this presentation, more importantly, we would like users to understand more about the downside risk of technical analysis. Technical analysis, more importantly, should be used when you are accumulating losses on certain stocks. A general disclaimer. Any example that we take in this presentation are just for educational purposes. Please don't consider them as buy or sell recommendations. Okay, now Georgie will give you an overview of how the markets have been doing in the last 2 weeks.
Okay, so since our last webinar on 11th July, that is again on a Tuesday, so we see that the Sensex had advanced like 1.52 percentage. So the last time we were talking, we were somewhere around here. So at that time we were saying that both the Sensex and the Nifty had almost uh, came and very close to the 50-day moving average, which is a key support level for both the indices, which was a pattern observed since the beginning of the year. So the indices found support near the 50-day moving average somewhere around like 2 weeks back, not weeks, like maybe like about a month back, and after that the indices have been moving higher. So from around these levels which we saw when we met last time, that is on 11 July, the indices continued to head higher. So the only minor blip which we witnessed was on last Tuesday. So the major development was like the GST Council had imposed cess on cigarettes, so which turned out to be a big drag for ITC. And being a market heavyweight, that pulled the indices lower, and which is very much visible on these charts. You can see on Sensex, uh, the Sensex was pulled down because market ITC went down. Same case with the Nifty as well. But outside of that aspect, you can see that the market has been moving higher, which gives you the sense of the exuberance in the market. So the Sensex advanced like 1.52 percentage, while Nifty advanced 1.82 percentage in the last fortnight. However, one thing, one factor that has been like distinguishing this bullish phase has been the underperformance of the Nifty mid cap. So you can see that during the last fortnight, like the Nifty mid cap advanced 1.54 percentage, and while the small cap index advanced 3.63 percentage. Generally, when you see bull markets, you see these broader markets like the mid cap and the small cap indices generally outperforming the headline indices like the Sensex and the Nifty. But over the last fortnight, what has happened is like Nifty mid cap, the performance has been very much in line with the Sensex and the Nifty only. Like it did not outperform as such. And also, like what has been witnessed during some of these trading sessions have been like even as the indices have moved higher, the market breadth has actually been in favor of the losers. So that means like more losers than the number of gainers on both the BSE as well as NSE. So that gives you some sign that there is some selective buying on going on in some stocks, while generally there is some signs of distribution happening in some of the leading stocks. So as an investor, uh, what you need to be doing is like as the markets are scaling new highs, you need to be finding stocks which are fundamentally solid and also exhibiting technical strength, while at the same time you should be careful in ensuring that you are not stuck in stocks which are starting to show signs of distribution. So if you are able to so as an investor or a trader, if you are able to follow your buy rules and sell rules in a proper way, there is a good opportunity that you will be able your portfolio performance can exceed the performance of the Sensex or the Nifty or even the broader indices. So that's one key takeaway from the market action witnessed in the last fortnight. Now, coming to what we have done with our model portfolio, uh, yeah, and also regarding the overall market direction, the market remains in a confirmed uptrend because, like, on this day when the Nifty, when the ITC fell, like we had a distribution day, but overall the distribution day count for both the Sensex and the Nifty remains at a comfortable level of 2. So the indices are in a confirmed uptrend, but still, what we are suggesting is like you need to be very careful when you are selecting your stocks because with the market in uptrend, like there is a good opportunity that you can pick good stocks and make good gains, but at the same time, you need to get out of stocks which are starting to show signs of weakness. Now, coming to the model portfolio, like in the last fortnight, we did not have any additions as such, but we removed 4 stocks. So these are some of the stocks which had done well, but which had started showing signs of weakness as I've been telling you earlier. So so this was what had transpired over the last fortnight. So now I will give back to Raghavendra, who will take you through some of the basics of the chart patterns.
Okay. Thank you, Georgie, for a positive market outlook. So, before we start off with the presentation on technical analysis, so this presentation is basically basics of technical analysis. It talks about the outline on how an investor or a user of MarketSmith app can start off with the technical analysis. So there are three basic elements that technical analysis is based on. First thing is trend. Trend is nothing but a certain direction that stock is showing, stock or the overall market. So trend, to speak more of trend basically gives us a long-term outlook for the stock. At MarketSmith India, we believe to invest in stocks when they are at high and book profits when they grow higher. So we generally in market, many of the novice investors, it's a basic mistake which most of the investors do. That is, investors tend to invest in stocks which are trading at lows, expecting them to go back higher. Generally, people, I've seen a few queries come our way asking for some stocks which are trading at lows and expecting that they might bounce back up. But one major thing to understand here is the stocks which are trading at 52-week lows are because of some reason. There must be some reason that has affected the stock and that has shown that distribution or that correction in that stock. So we always believe in at MarketSmith India. We believe in positive uptrend. That is the stocks which are showing a trend moving upwards. So trend is the first crucial factor of technical analysis that we follow here. The next thing is the supply and demand. Supply and demand, in simple terms, supply and demand, as we also know, supply and demand affect the market depending on the number of buyers and sellers. In case there's some stock which is showing some nice growth, and there is some new business model that the company has adopted, and as and when the story comes to the notice of the market, you see that there is increasing demand for the stock. So that is what propels the stock to grow higher, and it is what affects the stock in the long run. So always identify the stocks that are starting to show some uh, strength fundamentally. Identify the stocks that have some inflection point. That is when the business started to do something new. That is in canceling the N factor. That is something new. Either it might be about the management, it might be about some new product, it might be anything that is different from its peers within that group. So supply and demand kicks in because of the fundamental aspect. So the underlying growth factor or the demand for the stock is directly linked to the stock's fundamentals. So as and when the demand for the stock increases, the stock tends to go higher and higher. And in a similar way, when we see that there's something wrong about the stock, either if the stock is not able to deliver on its growth, that is earnings are not able to grow at a healthy rate, or else if the management is not efficient enough, then we see that gradually the stock might either trend flat, that is move sideways, or over the time it might fall off as well. So that is the other thing that technical analysis more or less talks about the price and volume action of a stock. So price and volume actions are derived by supply and demand. So whenever there is demand for the stock tends to trade high on volume, and the price will gradually move up. So technical analysis is indirectly dependent on the fundamentals and the growth story of the stock. The next factor that we should consider when we're looking the technical aspect of a stock is the support and resistance. So these are the levels where the stock it basically helps the stock to hold its value. So in case of the support, so we see that the stock, however good the fundamentals of the stock might be, it cannot go up forever. Like there might be some phase in its run where it tends to consolidate for some time. It might go on to form a consolidation pattern, a flat base pattern, or a cup with handle pattern. Then it might rest there for some time, and then it can resume its uptrend from there on. However, these support and resistance levels are crucial levels where where the stock will get some strength because of this is mainly because of the institutional investors. Whenever we see that a good stock is falling back to back and it is breaching its key support levels, that is when the institutional fund holding starts to kick in and help the stock to hold its key support levels. So an easy example, and a simple example here is, we see that most of the stocks, the good stocks which are fundamentally strong, whenever the stock breaks below the 50-day moving average or the 10-week moving average, we see that there, as soon as it breaks below it, the next 2-3 sessions, they tend more, in most cases, the stock tend to get up, bounce back off that level. So that is the key support level which most of the institutional investors look for, and that is one of the key aspects of technical analysis. So speaking of the trend again, here is a chart of Nifty. So this was a chart around this time where I'm pointing my mouse here. This is the time around which demonetization had affected markets, and there was a heavy sell-off here, and post which the stocks consolidated for a bit. However, in the subsequent sessions around end of December and early January, the market started to rebound and move upwards. If you see the trend, overall trend, we may not know the trend of a stock. In this example, we are taking an example of a index. Similarly, if we can consider a few stocks charts as well, if you look at its movement in the past 3 months, 4 months, or else even a longer period, maybe say 1 year, 2 years, the overall trend of the stock will reflect on the fundamentals of a stock. So unless the fundamentals of a stock are strong enough and consistent enough, we cannot accept this. We cannot expect this trend to continue this way. So this is a chart that put forward for this. So if you see here, whenever the stock is closing, it's coming close to its 50-day moving average line, the stock tends to find support, the index tends to find support there and bounce back higher. So even this case, we see it came back very close to the 50-day moving average line. However, from here on, it bounced back to again reach its all-time high. So this is an overall trend that investors should observe. So the trend basically gives you the it's just like in a glance you'll understand if the stock is fundamentally is the stock really good or not. So other thing which we believe in is, as I earlier stressed on it, invest at a high and book profits at a higher level. So any investor who would have invested thinking that the stock is currently trading at a 52-week high and it is not advisable to take to invest in such stock, that is a general mistake that most of the people do. So fundamentally strong stock move towards their highs as long as they are able to deliver on their fundamentals. That is the earnings. If the earnings and sales are growing at a good pace with good RO in place and good margins in place, the over the time the stock will trend higher and it will make new highs every month or so. So that is what investors should understand and believe in stocks that are making new highs and look for patterns that are look for stocks that are breaking out of new patterns. So this is a stock that this is a chart where we see an uptrend. Similar case, we have a downtrend here as well. So this is how a downtrend looks like. Overall, we see that this is the 50-day moving average line and this is the 200-day moving average line. So whenever there's a downtrend, we can clearly see that the 50-day moving average line lies below the 200-day moving average line. This means that the short-term performance of the stock has been really poor in comparison to its long-term view. That is the 200-day moving average line. So here, if we can see, as the stock kept on falling from here on, and it went on to make new lows. So this is a clear downtrend. Back to back, it started to make new lows. Here, it never found basically, if we can draw a line here, we can see that the stock was not able to rise higher and fall continuously. So this is an example of downtrend. It is not advisable to invest in stocks like these because there is some reason that is causing the stock to correct severely, and basically before investing we should take calls. I mean, we should understand what is the reason for its fall, and avoid taking positions in such stocks. Before we start, I'll quickly like to give on a broader view, I would like to give a simple example of how supply and demand works. If we remember back in, say what, to early 2000s when I was in my schooling, I remember, if you can see this picture, back then this Pokemon, Tazos and Jenga cards were really famous. So back then there were these chips packets wherein we used to get these cards for free. So every morning when I used to enter the school, and when I used to pass by the canteen, I used to see the canteen full of these chips packets. However, by the end of the short interval, that is not even halfway through the day's classes, I used to see the whole rack was empty. So that continued for a long time. Like around that time, this was a craze which a lot of young kids used to buy those chips packets not to eat but to just collect these cards. So over the time, we've seen that the price of those chips packets grew from 10 rupees to 15 and gradually to 20 rupees as well. So that is where we can see. So over the time, once we have a lot of demand for the product, over the time it tends to grow higher in value. So that is one example that was way long back, about 10 years, 15 years or so. And the next example where we can relate to is the recent case about 1 year or so, 1 year back, when Mukesh Ambani has released really competitive tariffs for his Geo SIM cards. We've seen that there were really long queues at the SIM card centers and also the Reliance stores. The normal SIM card, which costed about 100 or 200 rupees, would also, the people were even ready to buy it for 2000, even 1500 or so. So this was almost for a span of about 3 to 4 months. There was a scarce of all these SIM cards. People were not able to get SIM cards, and that was mainly because of the demand for the product. So there is something new that has entered the market. If you see until that point of time when Geo was announced, 1 GB of data provided by other competitors in telecom market used to cost almost about at least about 240 to 300 rupees. So, however, once Geo entered the market, it broke all the tariff plans, and it gave free data for almost say about 6 months or so. So that was something very new, and also it was really competitive, and it really affected the whole market. And that is a clear example of how demand for a product increases value for that product. More common example which we can think of is the air ticket. So whenever a person wants to travel around the festive season, that is maybe Diwali, Christmas, or the holiday seasons, we see that the ticket prices are almost 3 times higher than the normal prices which are on weekdays. So this is more mainly because of the demand for the product. So as the number of seats in a flight may not change. Like if the flight is having about 100 seats or so, they'll have the same seats, but the demand who are ready to pay for it might be really high. Like maybe like 300 to 400 people might want to travel through that flight. So that is when we see that ticket prices may go over the roof and really high. And the same case we see on a weekday. If you want to travel, then the prices are really cheap, and we get prices for almost about say about 1/3 of the prices that are there in festive seasons and on weekends. So that is more of a more common example that we can think of to explain this. So on a broader aspect, like demand and supply is very crucial for a stock in order to make its uptrend. So as long as there is demand for stock, as long as there are investors and institutional funds that are wanting to hold the stock in the long run, the stock will move higher and grow higher. So that is the main thing we should understand when it comes to technical analysis. In this chart, this is a flat base pattern. So basically, it's a pattern where I wanted to show how to understand the resistance and support levels for a stock. Uh, if we see here, so whenever a stock makes a good uptrend, like for example, even after before it made this flat base, a good stock might have made a good run of say about 30 to 40%. After it makes a good run, most of the stocks, good quality stocks, tend to consolidate for some time. There'll be a phase in a stock where it cannot move higher forever. There has to be some it's like the stock runs for some time and it rests for say about 3 to 4 weeks and again resumes its uptrend. So in this case we see this. So you might see that after making a good run, the stock tends to fall below its 50-day or other key support levels. So once it falls below that, it might find support. Support is nothing but a level where the stock always tends to bounce back up. So if you see in this case, the support level, it found support at this green line here. So at this instance here once, twice and thrice here. So in these three times, almost at the same level, like very marginal difference, the stock is bouncing back up, again falling to that point, and it is not able to breach that low. So basically it is staying at this level. So this is nothing but in simple terms, it is called as support level. It is basically the stock is finding support. So this mainly the support, I mean the how the support thing works is whenever the stock is losing its momentum, whenever we see that the stock is falling by about say 10 to 15% after making a good run, that is when the institutional funds come in. They provide support for the stock, they add some momentum to it, and they hold the levels at crucial levels, and they hold the stock for a while. So that is what improves of a stock's stability. And the stocks which are doing fundamentally good tend to have support levels which are not very deep, that are around its 50-day, 200-day moving averages. And they're generally whenever they consolidate, they do never consolidate like very deep. They might consolidate for about say 10 to 15%, but not beyond that in most of the cases. So if you see, this is like this is a flat base pattern where it has the stock has consolidated after making a good run. So after consolidating for about say 4 to 5 weeks or maybe 2 months or so, the stock again resumes its uptrend as long as the fundamentals are strong. So if in this case as well, the stock consolidated for some time after hitting its crucial support levels, the stock bounced back strongly to take over its resistance. Resistance is nothing but a level where the stock is not, where the stock is finding uh, excuse me, yeah. So where the stock is finding more supply. So basically where whenever the stock is hitting this level or almost close to this level, there's a lot of supply to the stock, and it is basically selling off on selling off, and the price is falling back down. So always look for stocks which are breaking out of key resistance levels, because these are the levels that are crucial. Once the stock takes over this level, then we can confirm that the stock is pegged for a good run. So in most cases, this applies that the stock will find support levels and resistance levels at certain points. However, it doesn't. It doesn't apply for each and every case we come across. More or less, if we see on the whole chart, we can relate to few to certain support and resistance levels. So to identify support and resistance levels and patterns more easily, the best way to do is when before I was introduced to technical analysis, I was really not so great with identifying the support and resistance levels. Gradually, as I kept seeing, looking at the charts and playing around with them like day in day out, and I at least look at say 10 to 15 charts in a day. So when you do that over the time, you tend to understand which are the key support levels. What is the pattern of the stock is making, and how strong is its rally, and how can it move further up.
Okay, so now we look at some of the critical aspects that you should be looking at while looking at some of these chart patterns. Now, the two most critical inputs when you're looking at any stock pattern or stock chart is price and volume. So basically, with price, as my colleague has said over here, like you usually have like the support and resistance level, because when the price of a stock comes down to a support level, people feel that the stock is cheap related to its intrinsic valuation, and people support by buying the stock. And while it moves to a resistance level, people feel that it's overvalued and maybe it's time to sell the stock. So generally, more supply keeps coming in at a higher level, and usually the stock sometimes keep trading range bound and all. So price is one critical aspect that we need to watch out for. And then the second aspect is volume, because uh, as you know, when a stock moves, like even if a stock is trending upwards, it cannot be moving upwards all the time. So even in a journey, when the stock is trending upwards, like there will be some days when you see some profit booking by some investors, which will drag the stock down. And alternately, when a stock is trending down as well, like there will be some days when the stock will bounce up, because some investors will feel that the stock has dropped to some lower level, and there may be value in buying the stock at that level. So again, on some days these stock might bounce back, but generally what we need to see is like the overall trend. So we need to see when an uptrend or a downtrend is happening, like what is the strength of that trend, so that we can ascertain by seeing the volume of each price move. So in an uptrend, what you need to see is like when the price is moving north, you need to see that it's happening on a higher volume. So that means like more investors are convinced with the growth story in the stock. That means more investors are buying into the stock. While when the stock is going down, you need to see the volumes drying up. That yeah, that gives you a sense that some weaker hands may be exiting the stock, but there is no significant pressure, selling pressure building into the stock. So so with these two aspects, like basically the price and the volume action, we will see how we can identify some buying points or entry points into some stock using these chart patterns. Now, so the founder of our company, William O'Neill, so when he started researching about some of the biggest winners during the last 5 decades, uh, he started looking at some of these big movers during his time, and he saw that some of these big winning stocks, like say Google or Yahoo and all, they started displaying some price patterns before they made their big up moves. So when you see big up moves accompanied by good volume as well. So as I said, like volume is also critical when we are doing this chart analysis. So if a good price up move is happening along with the volume as well, that means more buyers are coming into it. So most of the time, it is institutional accumulation rather than any demand from retail investors that is buying up the stock, because in most markets, be it in US or be it in India, like it's the institutional investors who have more hold on the stock market than the retail players. So you can imagine like people like you and me, maybe we may be having a capital like maybe 1 lakh, maybe 5 lakh, 10 lakh, or maybe 50 lakh, but that won't be enough to drive a stock higher. Maybe for some stocks like which are having like 500 crore, 5,000 crore and all. So so for a retail investor with this limited capital, he cannot drive up the stock prices. So most of the time, it's the institutional investors who have big money to invest. Like they are the ones who are driving up the stock. So, and also we see that it's a law of supply and demand that is coming into play when these institutional investors come rushing in, and they try to increase their stake in the stock. So basically, as my friend had told you, like he gave you some examples where when there is limited supply and then there is more demand coming in, like the price tends to move higher. So even if I think of a stock like say Reliance Industries, so which is now the most valued company in the Indian market. So if you look at its history, like over a long period since its listing in 1977, like the stock had run tremendously higher, like generating a huge wealth for investors. But after that, there was a period of lull. Like in the last 10 years, the stock did not give much of returns. But after that, like since the beginning of this year, the stock had started moving higher again. So what is happening in the stock is like whenever there is some growth happening in the stock, because in the market everybody is there trying to get the best returns. So these, especially these institutional investors, they do their valuations and they go and chase out for companies which are bringing better, which are having new products or new services which can drive the earnings growth higher. So these growth companies tend to attract the money from these institutional investors. So when Reliance was growing its earnings rapidly, like these institutional investors came in, that means the price of the stock went many times higher. But after that, you saw like during the last decade, like the Reliance was in a more like an investing kind of phase. They were investing into this fourth generation telecom network. They were doing more capex with respect to their petrochemical business. So at that time, the earnings growth was subdued. So at that time, we saw that like some of the institutional investors exited the stock and no real fresh buying was happening in that stock. So during that period, the stock stayed flat and underperformed the Sensex and the Nifty, which gave a lot of good returns during the last decade. But after Geo has come on stream and also some of these petrochemical projects are being commissioned now, many analysts are seeing that the earnings could be accelerating from here. Many earnings could be increasing from here. So you see that more funds are returning to the stock, and so like you're seeing like in the last say 7 or 8 months, the stock has started moving higher. Say from around 1,000 rupees per share, now it has raised to something like 1,500 now. So, so this is what you need to see in stock. Like, so there is some trigger on the part of the company, like maybe some new products, maybe now new management, or some new market conditions, which is favorable for the company to increase its sales and earnings, which attracts interest from some of these institutional buyers. So they come and buy the stock, which you can see on the, which you can infer from these some of these chart patterns. And so when such institutional accumulation happens and there is less supply of the stock and then there is more demand happening, so that's when price starts moving higher. And as a retail investor, if you can spot these chart patterns well and early in advance, like you can make the best of these price up moves. So we'll see how you can identify some of these patterns. So one pattern you will be seeing in most of these uptrending stocks is the cup with handle. So so with cup with handle, I will give you. So this would be one example of a cup with handle. Like, as you can see, with the line marked in dark green, so it's forming like a cup here. And after that, you can see that the stock trends down, making like a forming like a handle of the cup. So we will see what are the characteristics that you need to see for this cup and handle pattern to be ideal or to be more reliable. So we need to see a strong prior uptrend before the stock makes this cup and handle pattern. So and this strong uptrend, we usually look for around like 20 to 30% gains prior to forming this cup pattern. So the reason why we are saying we need to see a prior uptrend is that we need to be sure that we are buying into a stock that is going to run higher. We don't want to get into a stock that has been trending sideways or declining, and then this pattern is cup with handle or cup pattern is just a continuation of that downtrend or sideways. So because of this reason, we need to see a strong prior uptrend, and after that, like the stock is consolidating with some weaker hands moving out of the stock, and some more investors with higher conviction, they are getting into the stock. And next aspect is like the consolidation or the length of the pattern. That should be about 7 to 8 weeks. So in this chart that I'm showing you, like, so each bar, the vertical bar that you're seeing, that is that represents 1 week. So basically the lowest point in a vertical bar, so that would be the, say, the lowest price point. Sorry about that. So this would be the lowest price point during that week, and this would be the highest price point. And this horizontal bar you are seeing, that represents the closing price for that week. So here, if you are seeing, like, you can the overall timing of this or overall duration of this pattern is definitely more than 7 weeks. So you can count here, like, so 1, 2, 3, 4, 5. So it's like about 10 weeks. So which is quite ideal. The reason why we are saying like 7 to 8 weeks is like, when the time period increases, so by that time, people who do not have a high conviction in the stock, they will start feeling quite wary about the stock, and they will feel like maybe we can book out at this juncture. So these people with less conviction move out of the stock, and the institutional investors or the people with high conviction about the stock's growth prospects, they start moving into the stock. So so with stronger hands coming into the stock, their tendency to sell would be lower. So that's why we want to see, like, ideally at least 7 to 8 weeks for this cup and handle pattern. Even if it's slightly more, like 10 to 12 weeks also, it's quite fine. Yeah, and the next thing we would want to see is like the depth of the cup. That should be about 12 to 33%. So by depth I mean, like, so this is the last uptrending week before the pattern has begun. So from this point, I need to see that the lowest point of the cup, that is usually contained within something like 30 to 35%. And we need to see that the cup is mostly a smooth U shape, and at the end of the pattern we need to see a powerful breakout. So let me summarize what is happening, what the psychology of the market when this pattern is being formed. So the stock has run up higher until this point. So now some weaker hands are starting to exit, but by the bottommost point of this cup, some investors start buying into the stock. As you can see in these blue bars, so blue bars represent those weeks in which the stock is moving higher, and the pink bars represent the weeks in which the stock has moved lower. So in the last 3 weeks of this cup, actually investors have bought into it, and once it reaches here, like, some people might still think that, okay, it's a good price to exit. So you can see the stock trending lower here, but once all the weaker hands have exited, stronger hands accumulate the stock, and you can see a powerful breakout here. So by saying a powerful breakout, I mean that, like, the volume at the time the stock is breaking out, that should be much more than the average daily volume, because that gives you the conviction that even when the stock is moving higher, there is demand. There is still demand for the stock to buy it even at the higher levels. So that's it about the cup and handle pattern. So generally, this cup and handle pattern forms when the market is relatively less volatile and all. So this is considered usually a normal correction. And also another thing is, like, we would suggest is, like, don't take positions in the stock when it is at the middle of the cup, because you never know whether the cup will be finished as such. And also when the depth goes too high, maybe something like 60%, 70%, that might be a sign of some downtrend starting to happen. So don't think that the cup and handle pattern might eventually get formed and then you try to get in. So we suggest that as an investor, you buy into the stock once it breaks out of the cup and handle pattern, and also make sure that the depth of the cup is not too big as well. Now the next pattern that we are going to witness is like a double bottom pattern. So to give you a quick view of that, like, so it's something like this. It forms like a W shape. So after an uptrend, the stock starts falling, then it bounces back, but then again it starts falling, and here the low of the second low that will undercut the first low, and then it starts moving higher as well. Now, compared to a cup with handle pattern, usually this double bottom pattern you will see in a more volatile market. So what is happening is like okay. So before I get to that, so again the parameters for identifying a double bottom pattern, like usually an uptrend of around 30 percentage before forming the pattern. Again, a consolidation or duration of 7 to 8 weeks, and the correction or the depth of this pattern that should be ideally between like 12 to 33 percentage. And as I told you, like the right leg undercuts the left leg. Now the reason why I'm saying the right leg should undercut the left leg is that, so in a volatile market, so after this uptrend some people start selling out, but then the market starts pulling back, so the stock also starts moving higher. But now here, because of the overall volatility of the market, like people might start selling again, and here the second leg starts undercutting the first leg. Now this is very important because we need to be sure that any weaker investors who are there, they need to be shaken out of the stock. So when people who do not have a high conviction in the stock, or retail investors like us, see that the second leg is undercutting the first leg, you might feel like the stock is starting to make a consolidation, or maybe starting to move downwards. But it is at this juncture that most institutional investors might be looking to accumulate the stock. So as I told you earlier, like institutional investors with their big money, they usually buy stock based on some solid valuation or fundamental analysis they are doing. So once they see that like the stock has reached lower levels and they see that the valuations are attractive, then they start taking the stock higher. And so that's the rationale behind why the right leg should undercut the first leg. Now, similar to the cup with handle pattern, again you need to see that the breakout out of this pivot level. So the pivot level for this pivot level, or the resistance for this double bottom pattern, would be like the top of the middle part of a W. So you need to see the breakout here, and the breakout again should be happening on higher volumes to see that the conviction of the buyers in this stock, even at higher levels, continues to remain. Now we go to the third pattern called a flat base. Actually, during this presentation, we are limiting ourselves to this three patterns: cup with handle, double bottom, and flat base. The reason why we are limiting to these three patterns is that these are some of the three commonly seen patterns in these stock charts. So in this flat base pattern, I can give you a quick preview. So after an uptrend, you see that the stock sort of trades in a rectangular pattern. It's quite flat. After that, starts moving again. So this kind of pattern you see generally in a very more calm kind of market, when the market is not facing a downtrend as such. So it's generally like after an up move there is a small pause and some weaker hands get out, while some of the more high conviction buyers come into the stock. Now, so the characteristics of this flat base would be like again, like as in the previous patterns, like a prior uptrend of usually around 30 percentage. Now for the flat base pattern, the length of the pattern that we can take even at something like 5 weeks also, compared to 7 to 8 weeks that we are required in a double bottom or a cup with handle pattern. And in a flat base pattern, the correction or the depth of the stock from the highest point before starting the pattern, that would be slightly lower, because it would be like around 10 to 15 percentage. And as with any of the other patterns, we need to see a powerful breakout the moment it is breaking out of the pattern. So here, when you see the breakout of the flat base pattern, you need to see that it's happening on a higher volume as well. So you have seen the three common patterns that you see when a stock is making an up move. So now we need to see what we are going to do after seeing these patterns. So, as an investor, if you have to make gains going ahead, you need to see like how the big winners in the past have behaved before starting their big moves. So, so you can go to your MarketSmith app. You can in the MarketSmith India app, you can see the pattern recognition feature. Basically, it's like it's shown in these green lines. So you can see these patterns like flat base, consolidation, cup with handle or cup without handle as well. So as you start seeing more and more of these patterns, in the future your eyes will get trained to see these patterns as it is being formed. So so basically, trying to see the behavior of the stocks, past behavior of the big winners, and trying to see what you can do upon it, or what kind of action you can do to make the best out of identifying that pattern, can help you going forward, because you need to identify your plan of action when you start seeing these kind of patterns being formed in these stocks as you go ahead. And remember, like the stock chart you are seeing, uh, as I showed you earlier, like basically, like if I give you that weekly chart, what you're seeing in the chart is like the behavior of the market as on in a particular week. So you can see like how the market behaved in the past when it sold off, and after that what happened when some institutional investors came in and tried to buy the stock, and how much of a price impact that institutional investor had and all. So so basically, once you start seeing more of these chart patterns and try, and if you can read this price data along with volume data in a more coherent manner, you will be able to spot more patterns even without any pattern recognition feature on our app going ahead as well. So that's it. So that's all about like what we had for you this day. And if you have any questions, you can post in the chat box. We'll be happy to take them. Alternately, if you want to ask also, like you can speak out with your questions as well. So you can unmute yourself and speak. If you have any question, you can ask.
Thank you for such an informative session, team. I have a question over here.
Yeah, sure.
The pattern which we were talking, so we can apply those patterns on the new players also, or we need to go with the historical data of that particular stock or share on which we are applying the pattern?
So when you're saying newcomers, what does that mean? Are you talking about some IPO stocks or something like that?
Yes, I'm talking about the IPO stocks, or let's consider that the stock came out of the IPO and it is following a flat base for like 3, 4 weeks, and then even after that, if we see any particular pattern which we read over here, like cup with handle, so can we apply that pattern over there, or do we need to go only with the historical pattern of the shares, like for let's take an example of Reliance or Pidilite. So only with those which are there in the market, we can apply these patterns.
So whenever a stock is listed on an exchange, so IPOs are also, if you're talking about the new IPO stocks, what happens is, as we've discussed a while ago in previous slides, whenever a stock is listed on an exchange, the stock needs to show some price movement. That is, it needs to satisfy certain depth and length criteria. That is, it needs to trade for at least for 2 months in consolidation, and also it needs to satisfy certain depth criteria. That is at least say what 9% to at least 15-20%. So as long as it is meeting those criteria, the software will automatically identify the pattern. So when we talk of IPO stocks, it is advisable to stay away from IPO stocks which have been listed in last 2 weeks or so, Because in most of the stocks we see that it takes at least about 1 month or maybe at least about 3 to 4 weeks for a stock to get its stability. Initial 1 or 2 weeks, you might see that the stock's price is making a strong move, like say 20-25%, or else also the stock might fall off about 10-15%, and also volumes are all over the place with really exorbitant volumes. So we need to give some time for the IPO stocks and see that the stock gets back to its normal state. That is, the volumes are in place and it is moving in a stable, in a systematic pattern. So once you see that the stock is moving that way, that is when it is advisable to initiate positions. So as long as the fundamentals of the stock are good, it is advisable to wait for some time, say about 2 months or so, and see the stock has made some pattern or not, and that is when enter the position and enter the stock. So in this case, I'd like to state an example. For example, if we talk of Avenue Supermarts, or even if we talk of PNG Housing Finance. So PNG Housing Finance was listed somewhere in early this year, early 2017 2017 calendar year, and post its listing, the stock has showed some very volatile price movement. But soon after that, the stock consolidated for a bit. It formed a 4 to 5 week flat base pattern, and after which the stock broke out of that pattern. That is when at MarketSmith India we took a position. So from there on, the stock went on to give about say 35, 40%. It rallied for about 35-40%, and now again it started to consolidate for a bit, and now it is again making a flat base pattern now. So in Avenue Supermarts as well, after it was listed, the price action was really strong in the first few sessions. However, post that it made a pattern there, and it broke out of that pattern. That is when we entered. Now we are almost sitting on a good profit on that stock now. So whenever we are looking at IPO stocks, it is advisable to wait for its first base, that is the IPO base. And once the fundamentals are in place, and once you see the stability and consistent movement in the stock, that is when it is advisable to take positions. Does it answer your query?
Yeah, it answers. Thank you very much.
Any more queries? We are open for 2 to 3 more minutes. In case you have any queries, please post in the chat, or else. Okay. Uh, Here we see a query from Mr. Kunal. He's asked, can you please define an IPO base? IPO base is like any other normal base. It has to basically satisfy the length and depth criteria that we've discussed earlier. IPO base is the first base that the stock has made after it has been listed on the exchanges. So once the stock has been listed, we'll see that the price will move to and fro, and we might see some really strong price moves. But we generally what we've observed is in like the fourth or fifth week of its listing, the stock tends to move sideways or get some stability. So that is when it forms a pattern, that is say flat base, cup pattern, cup with an handle. So it might form one of these patterns, and that is called as an IPO base. IPO base is nothing but the first base that the stock makes since its listing. We're open for a couple more minutes. In case you have any queries, please post it in the chat, or else you can speak it.
For IPOs, we do not have access to fundamentals as in EPS or historical data. So how do we evaluate such stocks?
No, whenever any company comes out with an IPO, it usually shares an IPO prospectus. So in the IPO prospectus, you will see like some historical information. Usually, they will give out at least 3 years data of like their income statement and balance sheet as well. So maybe the
Okay,
concern
sir.
you are having is maybe some of these stock trading platforms, like say maybe money control and all, like they may not be giving they may not be showing this EPS data and all. But otherwise, if you really search out, like you will be seeing the EPS data. So even if you look at some stock like Avenue Supermarts, which are listed recently, if you visit our MSI app, you will be able to see the historical EPS data. Does that answer your query?
Yeah, it does. Thank you.
Yeah. So I guess we do not have any more queries. So it was a pleasure hosting you all for this webinar. We hope that you have been able to take something out of this webinar, and you'll be able to apply this knowledge when it comes to investing for your portfolio. So that's it from our end, and have a nice day.
Thank you very much, team.